All right, welcome back, traders. John Caruso here. Another edition of Futures Forecast. We are recording January 16th, Monday evening. Of course, markets were closed today in observance of the MLK holiday here in the United States. So we're going to do a review of last week's trading action, some of the data that came out, some ideas and thoughts that we had about last week's trading tape. And of course, we're going to take a look at about 4 or 5 charts with you guys this evening and hopefully get you set off on the right path going into this week. So first off, the S&P 500 traded up 2.8%, NASDAQ up 3.97%. Russell 2000 led the way, up 4.93%. We do think the Russell 2000 is coming into a pretty heavy overhead resistance area. So we are not, if the markets still have a little more gas left on the upside, we actually think the Russell 2000, the small cap, is likely in the beginning stages of stalling. At present levels. The gold market up 2.15%, silver up 2%, platinum was down to 2.63%, copper prices up 3%. So broadly, a lot of strength in the metals markets here. We're going to show you some of those this evening on the chart. Crude oil up 6%, gasoline was up 9.5%, heating oil up 7.78%, natural gas was down 7.7%, taking that decline over the last 4 or 5 trading weeks to about 45, 46%. Market's been pretty much straight down since the beginning of December. There actually might be kind of if you're an aggressive trader, there might be a long side opportunity. We do think we're on a pretty important support area, and we're starting to see some near-term bullish fundamentals that are starting to build in the natural gas market over the very near term. But full disclosure on the natural gas, if you're taking a shot on that trade, or on the long side, we've seen a lot of people asking questions about nat gas and when's a good time to start buying it. You do it in the options market. You probably buy a call spread or outright call options to try to capture that upside, something that has defined risk, because that market is still very much in free fall and certainly looks like trying to catch a falling knife on the chart. So that's natural gas. I think I've probably spent too much time on it already. 10-year yields were down 7 basis points week over week. We did see the CPI, December Consumer Price Index number, come out. Year-over-year number came out in line with expectations at 6.5%, but that was better than the previous month of 7.1%. So 6.5 on the year-over-year, besting the previous reading of 7.1. Month-over-month headline CPI did come out negative, down 0.1%, which was very interesting. Of course, that brought a lot of the soft landing narrative back to the fold here. So that's very interesting. Of course, we did see consumer confidence also beat expectations on Friday. So the narrative of a soft landing and the idea that the Fed is going to be able to pull this one off is starting to seep into the market. And of course, that contributed to a lot of the trading action that we saw last week. I still remain very, very skeptical of that call. And I actually welcome the soft landing narrative, because it presents more of a two-sided trade. It's been very lopsided here in terms of all the recession calls. That was largely consensus coming into this year, and perhaps still is. But it is nice to see that we're starting to get some traders on the other side of that idea. But ultimately, the signs of recession, they're all around. I think ultimately this cycle that we've seen, this risk-off cycle in the market, it's largely taken a lot longer. It's been a very drawn-out process. It's taken a lot longer than even we expected. We actually thought that it would happen a lot faster than it did. But I think part of the reasons are, obviously a lot of savings have been built up from the pandemic. The employment market is still strong and plentiful. As long as people have jobs, people are still confident in their bank accounts and their personal situations. And I think that is probably going to change, unfortunately, over the next, we'll say, 3 to 6 months. So still a few shoes left to drop. Corporate earnings and profits, we do think they're going to slow over the next 2 quarters. The employment rate, we do think that is likely to rise over the next 1 to 2 quarters as well. But the signs of recession, they're all around us. ISM manufacturing reading that came out 2 weeks ago showed a contraction at 48.4. Anything sub 50 in that space is contraction. The ISM services number came out 44.7. That is, I believe, the lowest reading we've seen since the GFC, the Great Financial Crisis back in 2008. And of course, the yield curve inversion. It's been inverted for several months right now. We're at minus 70 basis points. So the signs of recession are all around. I think the question is whether or not how deep the recession is. And to be honest with you, I think Wall Street would welcome a recession because they think that first signs of recession, that the Fed is likely going to pivot. So that's going to be interesting to see how that plays out. We, of course, are not in the pivot camp. I do largely expect the Fed is going to remain tight and keep interest rates elevated. Perhaps they make it to 5%. I think they're going to make it to 5% and probably hold for a period of time. So, going to be interesting to see how that plays out. I really don't know because the one thing that happens when you get this late in the cycle is you start to see corporate earnings and profits start to slow. You have the tendency to start seeing credit events in the markets. So we're going to wait and see and watch. But I think ultimately all of that is in front of us. So let's get over to the charts here. As you can see, I've got the S&P 500 up. That's a daily look at the S&P 500. Had this rounded bottom that formed after that 11-day consolidation period that pushed the market higher. Ultimately, we thought we were going to get into about 3960 to maybe 4,000, maybe a little overshoot to 4,025. We said that last week, and we are basically there right now. We're trading at 4,010 on the S&P 500. This market has momentum. I'm not going to lie here. Over the very near term, still has momentum on the upside. I'm not getting any signs of a top in here. Of course, we did get a little bit of overbought situation, got a little check down day, reversal back to the upside, sweated off that overbought signal, and now we are no longer overbought. So perhaps we're just kind of regrouping for another push higher. So it is possible that we get into this 4060 to potentially 4150 area in coming weeks. I don't quite think we're going to make it as high as 4150, perhaps 4100 on the upside is a possibility. We get into this resistance zone before we start to kick back, and that likely takes us into the February Fed meeting that comes out February 1st, which, of course, we do believe that the Fed is going to maintain their hawkish stance, and it would not shock me to see another Jackson Hole-style speech by Jay Powell at that February 1st meeting. There was one thing I'm going to read to you guys, a quick passage that the Fed released in their December minutes release, which was 2 weeks ago. Participants noted that because monetary policy worked importantly through financial markets, and unwarranted easing in financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability. So what I believe that is telling you right now is don't test the Fed's resolve. Do not test their resolve in terms of fighting inflation and trying to extinguish inflation from the system. So what that's telling me right there is we used to have the Fed put, where perhaps you get a 20% correction, the Fed steps in, saves the market, and we're back onto the next bull market. I believe that we actually have a Fed call option on the market right now that is going to stop. It's going to stop any rallies in the market. Perhaps 4050 to maybe 4100 is potentially where that call option is by the Fed, to where the Fed steps in and punishes risk assets once again. Because if you look at the trading action that we've seen over the last 2 weeks, I just read them out loud to you. We saw crude oil prices up 6%, gas prices up nearly 10% last week. Metals prices are ripping to the upside. Agriculture prices were all largely higher last week. The Fed does not want to see that. The Fed looks at that as counterproductive to their efforts. So that is my quick diatribe on that topic there. So we're going to switch over, take a look at volatility here. We showed this chart last week. Largely, we haven't changed any of the drawings on here. A lot of chop in the market down here. We expected some sideways chop. We did get an oversold signal down here. Ripped higher, got the overbought signal in here, failed. Of course, we didn't think that we were ready to run away on the upside here. We expected the market just to kind of chop sideways. That's precisely what we did. Now I'm staring at a VIX sub 19. It's not one of my favorite contracts to trade, but I actually think it's okay to be bullish on volatility from present levels. So we ultimately do think that the market is going to chop sideways, and into that Fed meeting, we're going to start to see volatility pick up. February, March, and April, we have slated as a period that the market could see volatility, could see upside risk, and stocks, of course, naturally could see some downside risk in the equity markets. Let's flip over to the gold market. Taking a look at gold. Gold has just been super strong. There's not a lot about this chart that I don't like. I'm going to go through it here quickly. So clearly, something changed over here when we broke through 1740. Our models flipped a bullish trend, and we've seen nothing but chop higher in the gold market. Now, potentially, we did get to 61.8. We thought that that was going to be a target at 1900. We've run through that level. I don't see any signs that this market's ready to peak just yet. I do have it drawn in here that we are expecting a pullback into that 1825 to 1800 area, where we think is going to be the ideal place to be buying gold for another shot back to the upside to 1900. And then perhaps we get some more risk off in the stock market. Perhaps we do see a bottoming process in the dollar. We are expecting a near-term bottom to form in the US dollar. Not that we expect the dollar to move back into a rip-roaring bull market like we saw for the broader part of 2022, but another retest higher in the US dollar. Perhaps that comes on the back of a hawkish Fed speech at the Fed first meeting. Perhaps it comes on the back of another retest of 380, 394% in the 10-year yields. Any of that, any number of those factors could set off a near-term correction back in the downside in the gold market. But ultimately, all roads lead to higher in the gold market, we think, over the course of the year. And I do think that we are going to see that test back above 2,000 and ultimately the all-time high later on this year. And we could start to see that bottoming process perhaps play out in April to May timeframe. So that's what we are looking at in the gold contract. We are going to flip over to the silver market, much like gold. There's not a lot not to like about this chart here. And silver had that little check down in here, kind of regrouped, sweated off the overbought signal, actually got an oversold signal down in here, and we have now pushed higher in silver. You got the 78.6 up there at 25.40. Ultimately, we might see a quick pop into this 26.40, maybe to this peak at 27.50 before we ultimately see some downside in silver. I'm not quite sure. We are starting to get a mini overbought signal in here in silver, but this is really nothing to really sweat about if you are along this chart right now. I do ultimately think that overbought signal probably tops out somewhere around 95 to maybe 99 before we start seeing this market kick back on the downside. So bullish trend, positive momentum, just barely sneaking into overbought. I still think this market is gearing up for another push higher into that 78.6 at a minimum to 25.40. Flipping over to the copper chart, we've been stalking the copper market here for a little bit. Thought this was ultimately a basing pattern and a sloppy inverted head and shoulders. That's precisely what it was. Market check down in here. I kept the drawing on here because we actually thought the check down was going to come back down in here closer to about 355, 356 before we were going to see the next leg higher. But that didn't happen. The market had other plans here. Check down, stopped out some managed money longs below 372, just jackknifed higher. This was your signal to get back in when we took out this peak at 395 back on the upside. And of course, we retested the 50% retracement level. And we have punched through that. So now that's opening up 61.8. We're getting some check down here. Ultimately, ideally, we'd think that this market's going to check down, retest the top of these peaks again at 395 before we regroup and make a run at 430. Whether or not it plays out that way, I don't know. I largely have missed this trade, and it's kind of a cardinal rule that I will not chase it. I will be patient. And if it does pull down into here to 394 to maybe 4 to 395, we'll look at taking a stab on the long side. There is a seasonal long side trade coming up. I believe it's at the end of this month. I believe it's January 29th. So we're going to see how the market kind of reacts in there. We don't base our trade strategy on seasonals, but we do look at them to see if they match up with the charts that we're looking at in our own fundamental and technical analysis of those markets. So switch it over. Lastly, we're going to review the crude oil market. Here's a daily chart of the crude oil market. Still largely, this is a very mature downtrend that we're seeing right now on the daily. We did stretch down here to 70.08, bounced, regrouped, sold off again into 72. We have since bounced, so we are kind of getting this, little rounded upside action here. You can see the market starting to kick back down off of this downtrend line. And I actually had it drawn on here to see this market ultimately break down to new lows. I don't necessarily think that that's going to happen. We might have another check down in here to 75, 76 before ultimately we start pushing back on the upside in crude oil. So I'm not doing a lot with crude oil right now. I do know the longer term supply side fundamental supply side story is bullish for crude. Not doing a whole lot in here with crude, but ultimately the market remains bearish trend. Still have risk of a pull down into 75 to 74 before perhaps it regroups and tries to punch higher, perhaps to about 83 to 85. I would get interested if we were potentially to get back above here, similar to like copper. You know, we have these old peaks up here about 93. If we're going to punch through 93, I think that's your signal to get back in for another run, potentially to 105 to 110 in the crude oil market. So that is a quick look at oil. So hopefully that was helpful for everybody. Hopefully that gets you started on the right track going into this week. We do have PPI due out on Wednesday. I am going to be watching. The BOJ comes out tomorrow, the Bank of Japan. There's a lot of rumors and prognostications about the Bank of Japan having to actually get more hawkish in policy. We did see the Japanese PPI numbers that actually came out Sunday evening, showed a reading of 10.2% on PPI versus an expected 9.7. So yeah, inflation's heating up over there. Yeah, the BOJ is worried about it. So perhaps they're going to have to be more aggressive in their monetary policy going forward. I have no idea what the expectations for tomorrow are. Perhaps they leave things unchanged for now and then get more aggressive at later meetings. There's even been some forecasts suggesting that the BOJ is eventually going to have to sell down some of their treasury reserves as they burn through their excess cash reserves, defending the yield curve peg. Of course, they're going through yield curve control over there right now. They're pegging their 10-year JGBs to 50 basis points. They will not let them get above 50 basis points. And of course, they're burning through some of their cash, their excess cash reserves. It's still plentiful right now, but there's been rumors that the longer the yield curve control goes on, the more they're going to be burning through those cash reserves, the more they're going to have to sell down the U.S. Treasuries, and potentially that could create a domino effect to where the Fed actually has to relaunch QE. God forbid. Sooner than expected. So, but that's a forecast. It does come from a highly credible source, but just kind of getting you thinking out there as to what could be coming down the road for later on this year. So I'm John Caruso. Best of luck to everybody out there. If you have any questions, feel free to reach out. Don't forget to like, share, and subscribe to these videos, and we'll keep them coming. Best of luck. Take care.